Hello, and welcome back to Portfolio Matters. It's been a long holiday season, but normal service resumes from here. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what do we have this week?
Thank you, Richard. Well, we have a packed schedule this week as we have 2 weeks worth of data to get through. But first of all, the news. So China's population appears to have peaked and actually fell in the latest annual data for the first time since 1961. But unlike in 1961, this reduction in the population looks to be the start of a permanent trend. We also had the IMF raising its forecast for 2023 global growth, citing the fall in energy prices, the fall in food prices, and a weaker dollar. So the IMF thinks that the world economy is resilient and will do better than it had previously been expecting. Now, on Thursday this week, i.e. yesterday, the US hit its national debt ceiling. Now, we have something on this later, but extraordinary conservation measures now go into action, and the US government should not actually start to run out of money until somewhere between August and October. All the indications are that the Republicans are going to play hardball, and the negotiations over the debt ceiling could be difficult. CDS on US Treasuries has leapt to 69 basis points. So the market thinks there is a meaningful chance of the US defaulting, which would cause total carnage. Previously, the debt negotiations have always been resolved. The other thing that happened this week is that the Bank of Japan met and unexpectedly left monetary policy unchanged. So they continue to target yield curve control on the 10-year and keeping it in a range of plus and minus 0.5%. In practice, that obviously means plus 0.5%, and they have been buying extraordinary amounts of the 10-year to limit the 10-year yield at 0.5%. In fact, indications are that they've actually bought 100% of the 10-year. We will discuss that further in due course. Okay, some charts relating to the news. Well, this is China's demographics. The white line is births, and you'll notice that being trapped at home during the pandemic lockdown did not lead to a rise in Chinese births. Meanwhile, deaths are continually rising, leading to a fall in the Chinese population. In the US, we had CPI numbers which showed that inflation continued to slow, and the market is now expecting the Fed to raise rates by just 25 basis points at its next meeting in early February. The Fed has previously stated that it will stay the course on inflation, and it will be interesting to see what the Fed does. And this is the debt ceiling. The US can now no longer issue new debt until they raise the debt ceiling, which means they'll be running down the Treasury General account. Okay, on to some economic data, and we have a lot to get through, and I will run through most of this. Okay, so in the UK, we had inflation numbers which were reassuring. So UK CPI fell in December from November to 10.5%, which was in line with expectations. Core CPI beat expectations, coming in at 6.3%, unchanged from November. RPI also beat expectations, came in at 13.4%, which was still very high, but much better than in November. We also had retail sales data for December, which was good. Retail sales in December grew by 6.5%, which was up on November and massively beat expectations. So the UK consumer is unexpectedly resilient. We had UK GDP numbers for November, which were disappointing, but better than expected. So UK economy grew 0.1% in the year to November, down from October, but beating expectations. Expectations were for a contraction. Industrial production declined by 5.1% year on year in November, and that was worse than expectation. The trade deficit, though, has been unexpectedly good. In November, it was only minus 1.8 billion, beating expectations, and the fall in energy prices has been good for the UK trade deficit. We also had UK construction output. In November, that was plus 4% year on year, down from October and below expectations, but still positive. And meanwhile, the UK claimant count is rising. So we had an increase of 19,700 in unemployment claims in December, and that was higher than expected and higher than November. We'll show you the chart in due course. Hourly earnings in the UK for November were disappointing, coming in at 6.4% year on year, higher than October and much higher than expectations. So in November, UK wages continue to rise, and that makes the Bank of England's job harder. In the Eurozone, economic sentiment had an enormous bounce in January. So in December, it was minus 23.6. It was expected to improve to minus 17. It actually bounced to plus 16.7. So an absolutely enormous change. So the fact that Europe has got through the energy crisis unscathed has led to analysts being much more positive about the European economy. Moving on to China, well, we had vehicle sales year on year in December, and they were down 8.4% year on year, lower than November and much worse than expectations. Industrial production was only up 1.3% year on year in December. Reminder, China has a target of 5.5% GDP growth, and it is well below that. Fixed asset investment also came in below expectations. Now, we also have a load of data on the US. So the National Federation of Independent Businesses Optimism Index beat expectations in December, but was still down on November and is below 100. So small businesses are not optimistic about the future. The big news last week was CPI data, which was reassuring. So CPI came in at 6.5% in December, well down on November and below expectations. So inflation in the US is coming down. Month on month, there was deflation in December. So that's great news. Core CPI came in at 5.7%, down on November, and again, better than expectations. However, month on month, it was up 0.3%. So core is still rising month on month. We then had the US Michigan survey of consumers in the US, and consumer sentiment bounced in January, up from December and better than expectations. And US consumers' assessment of current conditions improved massively in January from December, and again, much better than expectations. Now, how much of that is just down to falling gasoline prices? We will see. Also reassuring was US consumers' one-year inflation expectations, which fell to 4%, down from December and below expectations. Now, another piece of data we had last week was the Empire State Manufacturing Index, and that was really bad. So in December, it was minus 11.2. It's expected to improve to minus 5.2 in January. It collapsed to minus 32.9. So in New York State, manufacturing is not doing well. We also had US retail sales data for December, and that was not good. It was minus 0.7%, down from November and well below expectations. So although the US consumer is feeling better about the world, they're not putting their hands in their pockets and spending. Finally, building permits continued to decline against expectations, and housing starts also continued to decline. We have a special section on US housing coming up. There's also some quarterly data on China. So in Q4, Chinese GDP grew by 2.9%, which was better than expectations. And quarter on quarter, it was flat, unchanged against expectations of a decline due to lockdowns. Of course, there is a big health warning attached to these figures from the Chinese state. Richard, some charts.
Thank you, Keith. Very interesting update there. So we have a UK CPI, not behaving in the same way as the US CPI by any means. So it'll be interesting to see where that goes over the next couple of months. Very high, alarmingly high, I think, and significantly damaging to the UK economy, no doubt.
The difference between Europe and the US is, of course, energy prices, which have shot up massively, but are now declining. So hopefully you should see UK and European inflation coming down quite sharply in the following months.
Yes. And there's the UK core CPI, possibly topping, hopefully. UK RPI, which is, again, just a very unpleasant looking chart.
And enormous, 14%.
Yeah. UK British Retail Consortium year-on-year sales growth is actually, from the retail point of view, the economy is looking quite healthy. And UK GDP just about struggling to keep its head above zero. And that's the year-on-year growth.
Yeah.
Where next? UK hourly earnings, well behind RPI and CPI. And UK industrial production just looking really rather unhealthy. It's a one-year trend here. UK construction output, it's actually still quite positive, isn't it?
Yeah, surprising.
And the UK balance of trade has, and clearly this is a very cyclical figure, and it looks like it is sort of behaving as roughly as one would expect it to behave towards the end of the year.
Well, the thing is, it only rarely turns positive, generally when the UK is in recession. And the fact it has turned towards neutral from being absolutely terrible over the last few years is good for sterling, actually.
It is. And I wonder whether it's to do with the fact that sterling has, in fact, dropped significantly over the last 12 months or so, and it's making our exports more competitive.
Yeah.
The UK claimant count, of course, the Bank of England wants unemployment, so this is good news for the Bank of England.
Yeah.
So the EU balance of trade slowly pulling itself back towards zero. And as Keith pointed out, this is due to the EU having to import vastly more expensive energy. And we have these big regional variations in the balance of trade surpluses and deficits, with Germany running a big surplus, Greece running the biggest deficit, France and Finland, for example, somewhere in the middle.
Yeah.
Well, France's deficit is pretty big right now.
I still worry about the Eurozone.
Yeah, me to the EU Economic Sentiment Index is just above 0.
That is an absolutely enormous turnaround. 3 months ago, it was at its lowest level ever, and it's now turned positive. Absolutely extraordinary.
Presumably that's because we're now, halfway through winter, and there has been no catastrophe regarding energy consumption, energy prices, or energy availability.
Just to clarify what the ZEW Economic Index is, it's a survey of financial and economic analysts in Europe about what they think the prospects for the economy, etc., are.
China industrial production, as Keith says, comes with a health warning. In fact, just going back to that, it doesn't really make much sense, does it? Because when they're in the midst of that dreadful lockdown, industrial production year on year was growing.
Yeah, but the thing is, Richard, it depends on where those lockdowns occurred. If they occurred in the big cities, you might see a slowdown in services in China, but not in manufacturing, which is mainly done, in the second tier cities, etc. We don't know.
Yeah, and China GDP year on year, again, these come with a health warning. China GDP month on month, continuing to grow during the lockdown. China fixed asset investment. It's just really hard to equate these numbers with what we know is going on in China.
Yeah, I mean, the thing is, historically, China has relied on very strong investment, and it has a weak consumer sector. So how long can they keep the economy going through exponentially increasing investment?
Yeah.
Particularly when the demographics are now declining and the movement of people from the rural areas to the cities must surely now be ending.
Yeah. Yes. And there's the US Business Optimism Index, which is actually sort of still on a fairly steady declining trend. And the US IBD-TIPP Economic Optimism Index, which is well below 50, and again is appears to be still on its declining trend.
Yeah, that is a survey of consumers.
This is the US Red Book Index of retail sales year on year in the US, and the rate of growth is declining and has been declining for the last 6 months.
Yeah, so I'm going to cover this weekly from now on. So this is real data from stores in the US, and it comes out every week.
US retail sales have fallen in the last couple of months, suggesting a slowing down of the economy. And the US Empire State Manufacturing Index on a steady downward decline. US CPI,
sorry.
year on year, looks like it is starting to fall steadily. Whether it drops back to 2, of course, remains to be seen. And the month-on-month CPI, so we can just see it beginning to go negative. Core CPI reflecting similar. And the Michigan Consumer Sentiment Index starting to move back up.
I question how much of this is just due to falling gasoline prices. Consumers are very influenced by prices they come across every day.
They are. It's also quite a noisy chart, isn't it? Just generally quite noisy. So you need to sort of look at what the trend has been. It's hard to spot where the trend changes are.
Yeah. So also rising equity price. Generally, there's a lot of optimism at the start of the year.
Yeah. And the current conditions index, US Michigan current conditions index, just looks like it might be starting to rise a little bit, but it could easily fall back again. It could easily continue to rise.
Yeah, we have been here before. If you look at 2021,
exactly. And consumer inflation expectations actually dropping off quite sharply now.
That is unalloyed good news.
Yeah, and the 5-year inflation expectations appear to have topped at around about 3%.
Yeah, although they were up last month, ticking up from 2.9 to 3%.
Yeah. The 30-year mortgage rate has dropped a little bit, although it has, as we commented regularly, has more than doubled since a year ago. And US building permits have sort of come back onto almost fallen slightly below trend, actually. Had this extraordinary sort of post-COVID bound, I would say. And US housing starts has sort of come back to trend, pre-COVID trend.
Yeah, but both still very high by historic standards. We do have a section coming up on US housing later.
And the US mortgage market index is, what's the scale on this, Keith?
So, well, that's a good point, Richard. Okay, so it ticked up last week. Reminder that this is an index of all mortgages, both commercial and private, and this is it in context. So it did tick up last week, but not by much.
Context is very, very important here, isn't it, Keith?
Yes.
And US initial jobless claims are continuing to fall.
Yeah, well, this is very surprising.
Yeah.
The US labor market continues to be tight.
So US continuing jobless claims, no comment really.
Well, it's not coming down like the weekly jobless claims.
No, it's hard to interpret, I would say, because so our summary is the UK CPI is high, but we think and hope it is peaking. UK GDP was unexpectedly positive in November, just about, and our consumer sales are strong in December. So the UK economy may not be as weak as people have been suggesting. We'll see. UK wage growth was 6.4% year on year in November, which is high and will be causing the Bank of England concern. Also got a lot of public sector strife at the moment, looking for significant pay increases. Chinese economy is weak. There was huge improvement in European economic optimism in January, quite possibly due to the fuel Armageddon not having arisen over winter so far. US inflation seems to have peaked and is now falling. US consumer sentiment improved in January, but it's not good. And US economic data is steadily deteriorating. And what we have yet to see is US employment reflecting that situation.
Yes, but reminder, and we've covered this many times, employment is a lagging indicator. It's the last thing to roll over.
So when we see employment starting to roll over, if we do, we then know that we are possibly heading towards the bottom of the recession.
Yes.
Or the recession, the slowdown.
Okay, on to one chart. Thank you, Richard. And I thought this was a corking chart. So this is the number of companies in the Russell 2000 which are unprofitable. And it's currently over 800. So around 40% of the Russell 2000 companies don't make a profit. And what is going to happen to these companies as the recession comes and corporate lending rates rise and lending standards also rise? So the existence of these companies is dependent on shareholder largesse and their ability to keep on raising money to cover their losses. Now, what's happened is during the pandemic, there were a large number of unprofitable tech companies floated in the US, and they are currently surviving on their IPO proceeds. But as their cash starts to run out, so they will need further funding. Now, Carvana is an example of this. In Q4, it lost $3,255 on every car it sold. And it's rapidly running out of cash, and it's issued convertible bonds, etc., etc. It is a race to the bottom. Now, if we return to the chart, you'll see that the last time there was a tech crash back in 2000, the number of companies in the Russell 2000, which were unprofitable, fell to zero as they all went bust. Will something similar happen this time?
And so my comment here, Keith, is that in 2010, the Russell 2000 was around about 600.
Right.
And it's now at around about 1,800.
Mm.
So there are 4 times as many unprofitable companies in the Russell 2000, and in aggregate, it is up threefold.
Richard and I are fully expecting bad things in the US equity market. And so far, that hasn't happened. The US market's had a good start to the year. But, as all the economic data suggests that the US is heading into recession, earnings will fall, and some of this nonsense will just have to disappear. Now, this, by the way, is the share price of Carvana, and it has ticked up over the last few weeks.
And it's still valued at $1 billion.
Yeah.
So it was valued at like 40 billion or something.
Well, I think that was something like 100 billion, mate.
100 billion.
Yeah.
It's extraordinary for a used car sales website.
Used and new, but
my mistake.
Yeah, exactly. Get your cars from Carvana while you can. They're subsidizing you to the tune of $3,300.
I suspect Google is making most of that $3,000.
Yeah, no, I think you're right. Okay, on to Inflation Watch, Richard.
Thank you, Keith. So this table just recaps most of the information that Keith gave out at the start. Note that apart from Japan, all of the CPIs are down, and the EU core CPI is up, and Japan's core CPI is up. So Japan looks like it is lagging everywhere else in terms of its inflationary impulse, and everywhere else looks like inflation is peaking and possibly dropping.
That's a really good point, Richard, because the Bank of Japan meeting this week where they're capping yields. We've got a section on Japan coming up later, and they are doing absolutely shocking amounts of QE.
Yeah.
And if you think of inflation being a monetary phenomenon, then, they're just pumping the Japanese economy full of money. Inflation is rising. And actually, I won't do this now. We'll do this in a second. But warning, that's coming up.
Yeah. So as we discussed, pay growth is uncomfortably high, and the Bank of England will not like that because we don't want to get into a wage price spiral. And we have forecasts from Nordea that US inflation will fall sharply in 2003, back to almost the magic 2%.
Yeah, this is an extraordinary fall. The market is now expecting US inflation to fall really quickly.
Interestingly, so these CPI models have been adapted since inflation took off a year ago, because none of them projected that there was going to be significant inflation. And now, if you look, they track it perfectly.
Yeah.
Including the rise. So what that tells you is, it's just retrospectively, you can see there's something missing from the model.
That is a very good point, Richard. As we've covered many times, the great charts of analysts' forecasts for inflation, they're universally wrong, but we believe this one.
And the number of small businesses in the US intending to raise prices is falling rapidly, which clearly is a good sign for a reduction in inflation rates.
Yeah. To clarify, I think it's very dangerous believing this particular forecast. It seems very optimistic.
A chart of Americans with a job but not at work due to illness, and that has gone up by 50% post-COVID. And query, is it long COVID? Yeah. Developed market pricing pressures are dropping fast, according to PMI data. And the light grey line is showing the developed market price pressure. The dark line, the headline inflation rate. So according to this, it's not a great fit, is it? But one would expect to see the inflation rate declining.
Yeah.
This chart. And then the next chart suggests that US inflation may have peaked. So we're looking at the yellow line. But notice, of course, that inflation tends to come in waves, and we have had one wave. Will we get more waves?
I think the answer is yes.
Yeah, I think we will as well. I think we will because of commodity price pressure, particularly.
Yeah.
So we've got good signs that global inflation is peaking and hopefully will fall sharply in 2023. In the UK, we have got these persistent wage pressures, high industrial concentration, which gives labour in those areas pricing power, and tight labour markets, partly as a consequence of Brexit, significantly as a consequence of Brexit. And we have a history of inflationary episodes. So we have a few things militating against being able to control inflation easily.
Okay, on to US CPI. Thank you, Richard. So we know that US CPI is now declining and core CPI is also starting to decline. But if we look at the breakdown of US core CPI, there is a big difference between goods inflation, which is the green line, which is coming down sharply, and services inflation, which is continuing to rise. And so assumptions that US inflation will come down need to take into account the fact that service inflation is still rising. Now, why is that? If we look at services ex shelter, you'll see the biggest component is transportation. So transportation has caused a big rise in the services component of inflation over the last couple of years. Now, hopefully, as supply chain bottlenecks ease and the oil price falls, transportation prices should come down. And in fact, I think there could be a good chance that transportation inflation could go negative over the next couple of years. If we think about the investment in container ships, for example, we know there are a load of new container ships going to come into operation in the next couple of years. That will drive shipping rates down. And I expect a similar effect in other areas of the economy, including transport, including trucking. Now, reminder, shelter is 33% of CPI. And the US has this really idiosyncratic measure of shelter, which is owner equivalent rent. And that looks at not just what the market rent today is, but what the average renter pays. And as the average renter has a one-year contract, changes in market rates take a year to be reflected in owner equivalent rents. So you see the orange line is the CPI measure of shelter, and the blue line is the market rate. And market rates are coming down sharply, but the shelter CPI component is continuing to rise and will continue to rise for a while yet. So the net effect has been that CPI has underestimated shelter inflation over the last year and will now start overestimating it and keeping CPI too high. And this is the Zillow rent index in green, and it shows that rents are now falling in the US. And house prices are also coming down in the US, and there is a correlation between house price inflation and the CPI shelter component, and hopefully that should come down with house prices with a lag. If we exclude shelter, CPI is now negative. So core inflation ex shelter is also falling rapidly. Trimmed inflation appears to have been peaked. So the broad mass of CPI components, excluding the outliers, is now turning down. And sticky prices are also turning down. Hopefully, so 3-month annualized is now turning down. And the manufacturing and services prices paid PMI components suggest that disinflation will take hold this year and CPI should come down rapidly if the historic relationship holds. So the market is now expecting inflation to drop really quickly. But as we've discussed before, nobody has a good track record at forecasting inflation. And food prices should follow fertilizer prices down. So fertilizer prices have come right back down. Hopefully, food prices follow with a lag. Goods prices, again, should come down sharply. The blue line is shipping rates from Shanghai to the US. They've collapsed, and so goods prices should hopefully follow that down. Used car prices, which shot up during the pandemic, are now coming down. Energy prices also coming down, although we'll show you in a bit, oil prices have had a good couple of weeks. And hopefully the labor market has peaked and wage inflation has peaked, but it remains very high. So in summary, US inflation has peaked and hopefully will start to fall rapidly in 2023. However, because of the way the US measures shelter, which is 33% of CPI, the CPI measure will tend to be higher over the coming few months than underlying inflation. But the market is already expecting strong deflation. It's expecting the Fed to only raise rates by 25 basis points in February, and also CPI to fall to 2.5% by late summer. Now, what if they're wrong? The Fed has previously stated, given its dot plot, that it would raise rates by 50 basis points at its next meeting. Now, if it does so, and frankly, I expect it to, then that would be bad for the US economy, bad for equities in particular, given the market is now discounting a smaller rate rise, bad for short-term bonds, and bad for financial assets in general. It would be good for the US dollar and possibly good for long bonds in the US. If inflation proves to be more persistent than anticipated, then interest rates will have to stay higher for longer, and all the above remains true, except long bonds would also do badly. So if inflation remains persistent, that would be bad for all financial assets. Okay, on to recession watch. Richard.
So the US has a WARN Act, Worker Adjustment and Retraining Notification Act. So there's a federal law which requires employers with more than 100 employees to provide 60 days advance notice of a plant closing or a mass layoff, giving that information to each affected employee and or their union representative. The State Rapid Response Dislocated Worker Unit and the chief elected local government official. It's a little bit like we have similar sort of legislation in the UK regarding redundancies. So what this chart shows that the WARN notices are rising, and obviously they lead layoffs by approximately 2 months, 60 days. The red line is the WARN notices, and the dark line being the layoff rate. So what we can see is that the layoff rate is going to rise to around about 1.6. Given the current number of WARN notices, but it's going to be starting to spike upwards, I think is the point, which is going to suggest that we will be seeing an increase in unemployment or a reduction in employment. The Empire State Manufacturing Index, as we discussed earlier, was uniformly awful, so that will help reduce inflation, but will also presumably feed through into GDP, a reduction in GDP. the weakness is becoming more diffused in the manufacturing sector. So it's starting to show a wider slowdown, and you can see this is very rapid. In fact, I think even it's a larger decline than the actual COVID decline. Just eyeballing this, but certainly what this is all suggesting is that the US economy is weakening quite fast, or has weakened.
Yes.
And the signs are now coming through. And the number of US temporary workers starting to fall. And this tends to be a leading indicator of recession as opposed to the employment rate, because temporary workers can be stopped and started immediately. The number of US companies discussing job cuts is beginning to rise. It's not particularly high, but it is just beginning to rise. And US small businesses are feeling very pessimistic. And this is, it's interesting, this, because in the concept of where small businesses think they can do with their prices, they are not planning price increases, which actually tallies with a sensation of pessimism. And US commercial property prices are now down 13% from their peak. You could argue they've got a long way to go. And global leading indicators are not looking great, but on a 12-month view, which is the black line, they have started to move back up. So on the short 4 to 6 and 8 to 12 month time, the global indicators are very poor.
Yeah, it's interesting that the market is essentially expecting a bottom in 8 to 12 months rather than 4 to 6 months.
Yes. And we've discussed, haven't we, Keith, that once employment starts to turn down, it could be anything up to 18 months before the recession, you get the bottoming of the economy.
Yeah, absolutely.
So global lending standards and policy rates are tightening. And as we know, what happens is when the economy is booming, banks fall over themselves to lend, and consequently compete harder with each other. They're not bothered about credit risk, and lending standards fall. And then when they start to worry about credit risk, they tighten the lending standards, actually exacerbating the economic downturn. So they're tightening lending standards significantly now. They're nearly actually as tight as they were in 2008-9. Not quite there yet, but getting there. And that suggests that credit, the unavailability of credit, is going to start to cause a significant tightening of the economy. And interestingly, a lot of those 40% of Russell 2000 companies will be needing credit in order to stay afloat.
Yeah, precisely. Yeah.
And this is a chart, which is it's a monthly chart, shows that recently US financial conditions have fallen back a bit.
Yeah,
eased a bit.
They've eased a bit. So, which is amazing. We have seen declining junk bond yields, amongst other things. I mean, the market just seems very optimistic that the US economy will have a soft landing. And I just don't see that.
Well, I suspect what the market is thinking is as soon as the economy goes into any serious recession, QT will end and QE will initiate again. And I suspect, whether they're right or not, I don't know, but I suspect that's the sense, and it sort of explains this sort of behavior. The worse it gets, the more likely it is to get better. The Philadelphia Fed's coincident index means that it is no longer forecasting an imminent recession.
So can I come in here, Richard? Because last time I covered this, it was above the recession line, the dotted line, but they've revised it and it's now below the line. So the Philadelphia Fed don't think conditions were as bad as they had initially reported.
So UK electricity prices fallen a long way from their highs, but remarkably 3 to 5 times pre-pandemic levels. And it's good news for the UK government with its cost of energy subsidies. But it is still bad news for UK heavy industry. And there we are, the UK manufacturers say high energy costs, the biggest risk they face to remaining competitive in 2023. And clearly, right now, countries with low energy prices have a huge competitive advantage over countries with high energy prices. aka the US.
Yes.
1 in 10 UK manufacturers considering closures due to high energy costs, which is pretty dreadful.
Yeah. And the same will be true in Europe, of course.
So, I mean, where are we in the developed market downturn? So the US economy appears to be slowing, with a recession likely to be identified in second half. Often recession, the bottom of recessions is only identified retrospectively, so it's quite hard to know where you are in a recession. Temporary workers are falling, more companies are announcing layoffs, and the warn statistics are rising. Global leading indicators warn of a recession 2023. China is reopening, and that's going to have all sorts of big impacts on the world economy. And it's hard to forecast those impacts.
Yes. Thank you, Richard. And on to Japan. Now, events in Japan are absolutely extraordinary. So this week, we discussed earlier how the Bank of Japan has kept yield curve control in place at 0.5% on the 10-year, and interest rates are still negative. So this is the fashion chain Uniqlo, who have announced that they will raise pay for all staff in Japan by 40%, up to 40% this year. And if we look at the price of a cheeseburger in McDonald's, it's up 40% year on year. And as Richard described earlier, inflation in Japan is still rising, and the Bank of Japan is absolutely pumping the economy full of money. This is wages in Japan, and you'll see that wages are rising, and we are now in the annual national wage negotiations known as the Shunto. So let's see what happens there. Well, this is the Bank of Japan, and this is monthly purchases of JGBs, and the blue line is extrapolated for the whole of January from purchases in the first couple of weeks. Just absolutely extraordinary. Essentially, Japan now appears to have bought 100% of the 10-year. In fact, it might have bought over 100% of the 10-year because it's also sold JGBs to short sellers. It's insane. But it's not working because the 10-year swaps rate is now well above 0.5%. So the market does not believe that the Bank of Japan can maintain the 10-year yield at 0.5%. But the yen has recovered on expectations that yields will rise in Japan. And after the Bank of Japan meeting, the yen did not fall back. So Kuroda's term ends in March, and the market appears to be assuming that the current policy is just unsustainable. But while it continues, it's very good for financial conditions around the world. So very low interest rates in Japan are causing Japanese investors to sell yen to invest in foreign bonds. And you'll see that over the last 12 months, there's been a net 200 billion spent by Japanese investors on foreign bonds. And that supports financial conditions around the world. Now, if the Bank of Japan were to reverse its policy and allow rates to rise, then you might see this completely reverse, and that would suck liquidity out of the global economy and put it back into Japan. But as of now, they haven't done that. And so financial conditions in the rest of the world will continue to be supported by Japan. So this is a report from Bloomberg just showing that the Bank of Japan may have bought more than 100% of JGBs. So what are the implications of all this? Well, I don't understand why Japan is not in an enormous inflationary spiral, given the amount of money they're pumping into the economy. If inflation is always a monetary phenomenon, then you should have very high inflation in Japan. And we've seen that price of a cheeseburger has risen 40%, and companies are starting to raise wages by substantial amounts. All of that should mean Japanese inflation really starts to take off. Now, the reason that you don't have very high levels of inflation when you pump the economy full of money is the velocity of money has declined. But if inflation were to pick up and Japanese businesses, consumers were to lose confidence in the Bank of Japan's inflation fighting credibility, they might start to withdraw their money from the bank and actually spend it or put it overseas. And that would increase the velocity of money, and you would rapidly get an increase in inflation. But for now, the Bank of Japan has continued unlimited QE in the service of yield curve control, and that is bad for Japanese inflation, bad for the yen, despite its recent rise, good for the risk assets in the rest of the world. Richard.
Yes, it's an interesting case. So I was reading an article, I think it was this morning actually, where basically the author was saying that the situation in Japan is really quite unstable and that it could go rapidly wrong. Now, I'm not saying he's right or he's wrong. I'm just saying that it makes sense that they have got themselves into such an extreme position regarding QE by the Bank of Japan that I think there is potential for a discontinuity in what happens in their economy, which would be very bad for the economy of the entire world.
Yeah, I agree. But I think we all underestimate how socially cohesive Japan is.
Yeah.
The fact that, if taking a yen out of the bank and putting it somewhere sensible like gold were seen as socially unacceptable, you'd suspect that they'd all just keep it in the bank and let it, let the real value decline.
Yeah, we should have to see, but it's not a sustainable, as you say, it's not a sustainable policy, is it? At some point, something has to break.
Yeah, absolutely.
Thank you for telling us about Japan, Keith. And now we're going to move on to US housing. So since January 2020, the Case-Shiller house price index is up 41%, i.e. just about the start of COVID. And US mortgage rates have surged over the past year, and they've increased by over 100%. So the combination of higher house prices and higher mortgage rates means we've got surging mortgage payments. So year over year, they have increased 32.7%. And you can see that in 2020, they didn't change very much, the grey line. In 2021, they changed a bit. And in 2022, they have gone up massively. Consequently, we've got falling housing affordability. And the only way that wouldn't have fallen would have been if wages had gone up at the same rate as mortgage servicing costs, and they haven't. So housing affordability is now back to the mid-1980s levels. And the Atlanta Fed's home affordability index looks pretty dreadful. And the US median housing payment as a percent of median income has risen from around about 30% 2 years ago to 47%, 46% now, which is a huge increase and clearly has to have a knock-on effect in the expenditure of consumers elsewhere. So the red line is January 2022. You can see that pending housing sales, they obviously follow this they seem to follow this annual curve, but in January 2022, pending sales were higher than they are now. And so there is a continuing decline in pending housing sales. And home buyers are cancelling contracts that they have with builders. So clearly there was around about a 15 to 30% cancellation rate generally. Now we now have a 68% cancellation rate, which means people either can't afford it or they're waiting for prices to drop.
Yeah. And I should point out this is from one home builder, though, KB Homes, but you suspect it's general.
And median sale prices interesting, although they went up rapidly in the first part of 2022, and they only dropped back down to where they were in January 2022. So they have potentially a long way further to fall. And the price to rent ratio is very high. And if it were to drop back to sort of around about 80, that would suggest, assuming it was all taken up with house prices, that would suggest a 40% fall or so. So US residential investment, which is the amount of money going into construction of residential properties, is now moved negative year on year. But by historic standards, as we saw earlier, housing starts remain high. So despite a slowing housing market, construction sector employment is continuing to rise. And the question is why? And the following charts explain what might be happening. So here we have a graph. Over the past few years, a couple of years, there was a surge in new housing, the dark green line, but completions haven't kept up. And so there are a lot of unfinished projects. So contractors are working hard to complete projects, but they're not starting new projects. And that explains why there is continuing increase in employment in the construction sector, whilst there's a downturn in new starts. So we have this again with multifamily units. So there's a lot of unfinished work that needs to be finished. Contractors want to get it finished on the markets, off stock, and cash in. And they are working very hard to get rid of their stock of uncompleted units. So we have a record number of units currently under construction, and hence they have to hire the workers to complete those jobs. So this apparently contradictory signal we've got in the housing market of the market cooling rapidly due to rising mortgage rates and a collapse in affordability, and there being a record number of homes under construction and construction sector adding jobs, is really explained by the desire for these construction companies to complete units that have already been started. And when those completed units come onto the market, we would expect this increase in supply to put further downward pressure on home prices. And we would also expect construction sector employment to drop rapidly.
Yep.
And that should happen quite soon now, you would think.
Yes. Thank you, Richard. And while we talk about US housing, a US viewer who doesn't wish to be named sent me a load of stuff on US retail investors' investments in real estate. And I'm going to read this out. Linda McKisak from Texas was drowning in $600,000 worth of debt before she invested in 108 rental properties and became a millionaire landlord. Sterling White from Indiana was collecting welfare and selling Pokemon cards until he accrued a portfolio of 400 rental properties in less than 4 years. Stephanie Betters, a nurse practitioner from North Carolina, manages 1,000 units between shifts at the hospital. They're all guests on the Bigger Pockets podcast, America's #1 real estate investment show. Every week, host David Green, a former police officer turned rental property magnate, encourages millions of listeners to invest in rental properties and quit their 9-to-5. This was from a story in the FT last year. And what he advocates on his podcast is an investment methodology called BRRRR. Buy a property, rehab it, i.e. renovate it, rent it out to tenants, then remortgage it and repeat. And during the pandemic, an astonishing number of home sales were due to investors, claimed by up to a third. Now, it's since fallen back, but as of last January, so January 2022, a third of home sales were to investors, and small investors made up 27% of the market. Now, since then, investor purchases have plummeted, but according to Redfin, they still make up about 17.5% of the market in Q3. And what's interesting is a lot of the retail investors who own real estate do it under their own name rather than within a company wrapper. So the economics of this game are that it works when finance is cheap and it's easy to refinance and remortgage the properties you've rehabbed. But as we know, mortgage rates have doubled over the last year and lending standards are tightening. So that doesn't work anymore. It's also best when rents are rising, and we know that rents are falling. And in particular, when the economy is growing and tenants have a low risk of losing their job and defaulting on their rental payments. Now, we know the US economy is slowing, although the labor market remains tight and unemployment is low. But if the US goes into recession, then that also becomes a problem. And finally, when house prices are rising and you also get capital gains and it's easy to remortgage, and we know that house prices are starting to fall. So in summary, the game don't work no more. So this is US lending standards, and they have tightened. These are lending standards to small firms, because I couldn't find the lending standards to on retail property investors, but I suspect the charts look the same. Rents are falling and house prices are falling. So the consequences of this are that the extraordinary rise, which we reported earlier, about 40% in US house prices, has in part been caused by extraordinary demand from retail investors, and that will now disappear. And so a key support for US house prices will also disappear. And as the US economy slows and rents fall and renter defaults rises, so all these retail landlords with these extraordinary, highly leveraged property portfolios could start getting into trouble. And that raises the possibility of financial distress and fire sales of US property. So watch this space. Investment implications are US housing markets likely to fall further. US financial institutions may be faced with a wave of defaults. So avoid banks with large residential real estate portfolios. And as the housing market declines, so it leads the US economy into recession, which would be bad for equities, commodities, and good for bonds. On to other charts, Richard.
Thank you, Keith. So a few other charts. The global housing bubble in every country, except, ironically, Japan. Japan has had a housing bubble, obviously, but it was a long time ago.
Yeah.
But look at New Zealand and Canada, particularly.
Yeah. And this is price to rents, it's not prices. This is a very good measure of just how overextended the property markets are around the world.
Yeah. Chinese household savings have expanded enormously during the lockdown. They haven't had anywhere to spend their money. And so if they do go out and spend their money, that clearly is good for the Chinese economy.
Yeah. So the same things happened in China as happened everywhere else in the world during lockdown. And that led to an enormous boom the moment lockdowns ended.
Yeah.
And inflation.
Yeah, true. And Chinese consumer confidence is recovering, obviously due to the ending of these lockdown restrictions, which should drive retail sales growth and should see a bit of an economic boom, as Keith just pointed out. And China is boosting its infrastructure spending to try and lift itself out of its malaise caused by lockdown. And as we know, commented on here for a long time, the Chinese real estate market is in trouble. So this is a chart of Chinese economic activity. And at the bottom right, we have Chinese home sales. So it's hard to see how the Chinese real estate investment sector can recover if home sales don't. And borrowing costs have fallen in Europe, and the conclusion here is that China is the market getting very complacent about European corporate debt. And if well, yes, probably is the answer. Complacency surrounding Chinese dollar bonds, Chinese junk bonds, dollar junk bonds are in significant demand again.
Yeah, they're up over 50% in 2 months. It's extraordinary.
Since the ending of the lockdown.
Yeah, the market just is going through a bout of optimism, I think. Okay, after all that, we need some good news. And this is plastics on Australian beaches, which has fallen by 30% in 6 years through basically targeted measures to increase the ease with which people can dispose of their plastics in a responsible manner. So if you identify a problem and deal with it, it can work.
Yeah.
And I like this. And I thought, actually, given my own portfolio, something we should bear in mind. And onto equity checklist, Richard.
Thanks, Keith. So the markets have started off this year in a very buoyant mood, haven't they? So year-to-date change, bearing in mind we're still 3 weeks in. FTSE All Share 4.3, Stocks Europe 6.1, S&P 500 only 1.5, Nasdaq nearly 4%, Hang Seng 11%, Topix only 2%, Bitcoin up 26%, the pound and the euro up against the dollar by between 1% and 2%, the dollar index down by about 1.5%, which makes 10, and VIX falling because all of the above have been rising, particularly the US market has been rising. So a very positive, buoyant start to the new year, with the exception of the US dollar. So there we have the dollar index, which has really fallen a long way back quite quickly since its sharp rise up from about May, June onwards.
Yeah, markets generally don't go down in a straight line.
No.
I think there'll probably be a bounce at some stage.
Yeah. And there's the VIX still loitering around the 20-point level where one should sell. I was looking at this morning, actually. It can stay at this level for quite a long time before it rises back up to the... so, you know, if you entered that trade as selling the US 500 on the basis of the VIX, you just have to sit on your hands and wait.
Yeah, I'm actually tempted to have a little punt on this, my, spread betting account.
Exactly. Why not?
Yeah, exactly.
And we have this yield. We just have to remember that the US is likely to enter a recession. The yield curve is very negative. And as you can see from that chart, it's as negative as it has been since 2019. I can't read that, but many years ago.
Yeah. So despite the equities are having, great start to the year, but the bond market is saying we're going to have a recession.
Yeah. And private investors have been selling equities hard, which is probably good news for the markets in the sense that it has to happen before they can reach a bottom.
Yeah.
And all the asset classes are in negative long-term trends, stocks, bonds, and commodities in negative long-term trends. Interestingly.
Yeah. So if you follow long-term trends, too early to buy basically anything. And
if you just overlay this current market with previous bear markets, they look very similar.
Yeah. So I just think we're in another bear market rally, and not to get carried away, frankly.
I mean, I guess it would look similar, really, wouldn't it? But...
Well, unless it breaks out decisively.
Yeah. And taking out the big tech names, we know what they are, the FANGs, etc. The S&P has had a strong quarter. And is this reality-based or is it hope-based? Earnings revisions are deeply negative, which is what you expect as you're going into a recession.
Yeah. So, the S&P has been recovering, doing well, but earnings revisions get worse and worse.
And earnings are highly correlated with the ISM. The ISM is falling fast, and so earnings are following, as you would expect. So earnings revisions tend to occur prior to a recession, 2008, 2009, 2020, and 2023 has a significant number of earnings revisions, even though we're only 1 month into the year.
Yeah. And you'll notice that the market is still expecting earnings growth 2023 relative to 2022.
Indeed. Good point, Keith. And one would expect US profit margins to fall as orders have declined and you move into recession, and that would suggest that with a constant price earnings ratio, the prices should fall. Obviously, earnings will fall.
Yeah. Actually, can I just come in there? Because what I covered last week was the fact that employment in the US was staying high, but the ISM was showing that new orders were declining and companies were increasingly pessimistic about their future project prospects, but they were not pessimistic about their hiring intentions. Now, if those two are true, then margins must come down. You have falling revenue, but your costs are staying the same.
So US corporate debt has grown quickly, but hasn't grown as fast as earnings. So as long as earnings are maintained, the debt remains serviceable. But if earnings are unsustainably high, which it looks as if they probably are, then that also brings into question the sustainability of debt, as well as the pricing of the equity. And this is a technical term, meaning the stocks that one considers most likely not to be worth as much as they're valued at has bounced hardest in the January everything rally. So that's interesting, isn't it? And the ARK Innovation ETF is up 25% from its lows. Yeah. Although on a long-term chart, it's like a little blip. And even Bitcoin. And Keith, you're such a cynic.
Yeah. So have you got any Bitcoin, Richard?
Not at the moment, no. And global equities are starting to outperform US equities. And global equities have underperformed US equities for a long, long time. And obviously US equities have become relatively overvalued.
Well, 40% of the Russell 2000 doesn't make a profit. I mean, there's just extraordinary tech speculation that's driven the US markets up.
Yes. And recessions tend to cause negative equity returns for more than just a single year. So that's interesting, isn't it? It's not a down and up when you're done. You have to give it time. We work in a very instant world, I think. Yeah. And sometimes with these things, you have to give them time.
Yeah. Thank you to Draw It for not just this chart, but several other charts that I've included this week. Okay, on to commodities. So pause, take a look. This is the performance of various commodities during 2022. The best performer was coal, up 157%. The worst was magnesium. Surprisingly, natural gas was down 20% on the year. That's Dutch natural gas futures. And if China is reopening, well, China is a huge consumer of base metals. So it consumes over 50% of the world's aluminium, nickel, copper, and almost 50% of its zinc. So if China reopens properly, that's a huge story for industrial commodities. And onto energy commodities. Well, oil has had an absolutely extraordinary couple of weeks. It's now, having fallen sharply in the opening days of the year, it's now up. So Brent was up 9.4% over the last couple of weeks. WTI up 8.8%. In Europe, the mild winter and good gas supply from LNG means that gas prices continue to drift off, down a further 20% over the last couple of weeks in both Holland and in the UK, and also in the US. US natural gas futures down 22%. Coal, as I've warned previously, starting to come off from its very high levels, down 7.8%. and uranium flat. Some numbers specific to the oil market. Well, this is interesting. The year has been characterized by big builds in crude inventories in the US. So over the last couple of weeks, we have had a build of 24 million barrels in overall crude inventories in the US. That is very bearish for oil prices, but oil prices have shot up. Go figure. Excluding the SPR, the build is 25 million barrels. US crude production ticked up to 12.2 million barrels, its recent high, and the Baker rig count is also recovering, up 5 on the week. This is Brent. So after that sharp drop in the first week, it's now recovering. The dot is 2023 Russian crude exports. So defying expectations of a collapse, Russian crude exports have held up pretty well, although Europe now imports more energy from the US than it does from its neighbor Russia. And I thought this was amusing. This is Chinese oil imports from Malaysia. So the dotted line is Malaysian oil output. The blue line is Chinese imports of Malaysian crude, which are clearly made up of rebranded oil from Iran, Venezuela, and Russia. So, it's a great example of how sanctions don't work very well and are evaded. And the EIA is forecasting that if China reopens, Chinese oil demand will hit a record in 2023. But at the same time, they are forecasting that world oil supply will exceed demand in 2023, and that would be bad for oil prices. Be aware. Now, the FT had a special report on US shale, which showed that US shale costs are rising rapidly again, while production per well appears to have peaked, and that is not good for the economics of the shale patch, which has been briefly profitable. But is that falling again? If oil prices fall, then you could see shale becoming unprofitable again. This is European natural gas futures, which continue to drift off, and Norway has made an absolute packet out of the EU over the last year. So the red line is the price that Equinor receives for gas. The extra amount of money that Norway and Equinor have received over the last year is equivalent to 40,000 euros per Norwegian household. So this is UK natural gas futures, which also have drifted off, but we showed you earlier that they're still 3 to 5 times higher than pre-pandemic. These are US natural gas futures, which are also falling. Coal had an extraordinary year, was the best performing commodity, and is starting to come off. It is a natural competitor to gas. Gas prices are collapsing. I would humbly suggest if you have coal investments, now might be a good time to sell them. Uranium flat. Industrial commodities, Richard.
Thank you, Keith. So I think the reopening of China, as we saw in an earlier chart, has really sort of skewed the movements in industrial commodities. So we've got quite a lot of volatility. So I'll just do the year-to-date changes, actually. So aluminium's up 10%, cobalt down 6%, copper up 12%, chromium not really changed, iron ore up 5%, lithium down 10%. Then neodymium unchanged, nickel up down 7.5%. Nickel we know is hugely volatile. Tin up nearly 20%, and zinc up 15%. Ferrite, vanadium unchanged. So I think we're definitively seeing the China effect coming through in these prices and the volatility of them.
Yeah. The question is, Richard, how much is the market anticipating Chinese demand? and how much is actual Chinese demand? We won't find out for a while yet.
We won't indeed, will we? And the Chinese have got huge stockpiles of all these metals, I think. So there's aluminium, cobalt, copper.
Well, Dr. Copper is diagnosing a recovering world economy.
Indeed. And there's a chart that shows, we've shown this periodically, copper inventories are very, very tight, and copper demand is due to rise substantially over the next few years, substantially above production levels. Chromium, iron ore, gone up 50% in the last 2 months.
Yeah, absolutely.
Lithium, I'm not surprised it's fallen back, frankly. Neodymium, nickel, still sort of gently chugging upwards. And tin is starting to climb quite hard again. And again, that one is up about over 50% since then.
Yeah, electronics demand.
Yeah.
Tin's used in solder.
Yeah. Ferrovanadium, really going nowhere for the last 9 months, 8 months. And zinc, up like 25% in the last 2 months. And just looking at the precious metals, gold has had a good year, silver almost a good year to date, I should say. Silver not moved very much, platinum down 3% year to date, rhodium hasn't moved, and palladium down 2%, but gold has started off strongly.
It has.
And there's the price of gold.
That's a big move in the last 2.5 months.
Yeah, it's up, was it 20% or so from the from November? Yeah. Silver has also had a chunky move since November, actually.
Yep.
Platinum, rhodium, and palladium. Keith, interest rates.
Well, thank you, Richard. So, over the course of the last couple of weeks, UK 2-year yields rose, but the yields at the longer end of the curve came down. Now, that suggests to me the market is becoming more confident about the outlook for UK inflation. They're saying the Bank of England will raise rates and that will bring inflation under control. But the big moves were in the periphery, where we've had continued declines in the yields of Greek and Italian bonds. Now, I thought this was a really interesting chart. And what this shows is during the 1970s, when inflation came down during recessions, bond yields fell. But when the economy recovered, bond investors believed that inflation would come back and bond yields spiked, even though inflation actually didn't spike. So bond yields could be expected to rise no matter what happens when the world economy starts to recover, because investors such as us on this podcast believe that inflation will return even if it doesn't. So be aware. Global leading indicators are turning down, and the MAC bond models suggest bond yields should also turn down now, although so far they haven't. And I am very much expecting that they will. So that, to me, represents an opportunity. Now, thank you to Jaw It for sending me this. This is really interesting. So 0 here is the start of recessions, the average of recessions in 1969, 1973, 80, and 81. And I am expecting that the start of recession to cause bond yields to fall. But actually, in the 1960s, 70s, and early 80s, the start of recessions tended to see bond yields actually rise, which would be absolutely disastrous for my investment strategy. So, first question, is it true? And so I put this together on the St. Louis Fed website, and it is true. The blue bars are the dates of recessions in the US. You'll see 70, 73 to 75, 80, 81. Bond yields, this is the 10-year, did rise over this period. What's going on is the fact that inflation also continued to rise during those recessions. So, reminder, you had extraordinary oil shocks in 73 and 1979 to 80. So that was caused by first the OPEC oil embargo and then the Iranian Revolution. And then you also had very strong union power and inflationary spirals. And we do not have any of those now. So I don't expect inflation to keep rising as the world economy goes into recession this time. This time is different from the 1970s in that respect. Okay, some charts. This is the UK 10-year, which has come down a bit. We've had good UK inflation numbers, or when I say good, inflation numbers in the UK which didn't get worse. It's the UK 30-year, US 10-year starting to come down. German 10-year also coming down, Italian coming down. Now, when we think about this year, one of the things that I've talked about previously, and I think the market needs to understand, is how Italy is going to fund its deficit. But right now, the market seems complacent about the Italian finances, and the bond yield is coming off with German yields. This is Greek, same. And finally, on to our view of the different asset classes. Richard, any changes to your view?
Yeah, a gradual change, I think, in terms of industrial commodities, which you'll see in a moment.
Okay. And concluding comments. Well, equities and industrial metals have had a good start to the year on expectations that China reopening will lead to a stronger world economy, and also the fact that energy prices have fallen, which is a good stimulus, and Europe has survived the energy crisis. But as we've shown you, all the economic indicators continue to show a world economy that is slowing, and we very much expect a recession later in the year, and that will be bad for corporate earnings. Richard, what do you get up to this week?
So thank you, Keith. So my change for the year is up 7.8%. That is because of what's been going on in the my precious metal holdings, basically. Well, obviously the FTSE All share was up 4.3%, which gives me only a relative performance of 3.5%. But Keith, further to your question of a few moments ago, I have bought some Antofagasta for exposure to the copper market, and also, you know, ChatGPT, the AI.
Oh, yes. Yeah.
Well, I think that AI and robotics and the combination of the two are going to play a very rapidly increasing role in industrial and service applications. And so I bought the iShares Robotics and AI ETF, not very much, because I am concerned about the direction of the stock market, obviously. And then NVIDIA, which makes high-end graphics processing units, which are used in AI computing, which is very, very heavy on computing power. So NVIDIA is pretty much the only company in the world that makes these high-end graphics chips, I believe. And so that's a long-term investment in effectively the picks and shovels of AI. So it's a big change from where my portfolio was all last year.
Well, I think it's a good idea. I just question whether right now is the time to do it.
Really, really difficult to know, Keith. I've got the charts on here, but I completely agree with you. It's very hard to know, which is why I've just made small investments, and the timing, you know. So this is Antofagasta, which has obviously had a big run since. This is a long-term chart going back to 2000. It's also had a big run up in the last couple of months, which we've just seen in the commodities. But there is this impending, looming shortage, huge shortage of copper as we try and electrify the world, which we've talked about before. I don't have any exposure to copper until now. And I thought with the Chinese reopening, the move in the copper price, now is the time. This is the iShares Robotics and AI ETF, which doesn't have a very long history, but you can see that since beginning of 2022, it's sort of roughly halved. I would have bought it just about here, and has it, it's going to be moving in with the US market, obviously, but whether it starts to move differently to it remains to be seen. This is NVIDIA, which is dropped to almost a third, well, around about a third, so dropped 66% or so from the top. But again, I've just bought it around about here. We shall see. So this is a price. This is a gold chart. So again, a long-term gold chart, go back to 2015. My view is it's currently within this range, and in order to break out, it needs to get above this point here. So yes, it's good, but it is in a range, and it hasn't broken out yet. This is the Junior Gold Miners ETF, which just shows what junior gold mining companies are doing. And they are still in this downtrend. It's a very broad downtrend. And obviously, gold breaks out. These will probably break out here. I was just experimenting. Oops, sorry. I was just experimenting with the channel there. I don't like it particularly, but so you can see that silver really is sort of bouncing around again in a big trend, a big range, very big range. And then this is a junior silver ETF, which may possibly be, again, the breakout will be here. This is the Wisdom Tree Industrials Metal ETF, which I think is interesting. So if you want to place a bet on industrial metals, I reckon this is probably a reasonable way of doing it. I don't own it, but it will give you a broader spread than an individual metal. And again, since November, it's had quite a good run, having been almost twice the value. I've lost 50% of its value in 2022. So I think that's me, Keith. How about you?
Thank you, Richard. And I'm very pleased to report that I had a good week for once recently. And I'm struck by, we do this podcast together, but our portfolios are very different. So I was up 3.3% last week. Hurrah! And up 3.6% on the year, trailing Richard by a long way, but trade down relative to the all share.
A long way to go yet, Keith.
Yeah. Now, last time I was saying that, how my bond trade was not working and I should stop, adding to it. And then promptly I went skiing and the trade started to work. And I wish I'd done more. That is, the story of every investor, I think. But so this week I came back, I added a tiny bit to it by selling some of my basically cash ETF and buying a bit more of the US Treasury. Now, if you can buy the dollar hedged 20-year ETF, that is a superior instrument. I can't. So I'm buying the instrument with dollar exposure, and obviously the dollar's falling just as the bonds prices start to rise. So it hasn't been a great return, but I think the dollar will actually have a bounce at some stage. So added a bit to that, and then added to my index-linked gilt and to my 2071 gilt, but only in small size. I have learnt my lesson about putting too much in. I've got enough already. So this is the US Treasury 20-year plus, and you'll see it's come down a long way, and hopefully it's forming a bottom. And this is 2071 gilt. That is my good couple of weeks, frankly. Let's hope that it's formed a resistance layer down there and will now build from there. just look at the scale, though. If that were to return to where it was, a month and a half ago, that's a decent return. Actually, that takes me back to flat. And this is the 2068 index-linked gilt, massive risk. And, I'm hoping that as inflation expectations come down, this really starts to motor. But it hasn't as yet. But, it's off its lows. Hurrah.
Well done.
So congratulations to Richard on a very strong start to the year. And we are now both back for a while. So hopefully you'll see regular updates every Friday. And I realize that I owe everyone a few special podcasts. We will be working on our lessons learnt over the course of 2022. And I hope to get Richard, Stewart, and I together to discuss that by the end of the month. In the meantime, thank you for all watching through to the end. Please can you press like and subscribe to the channel, and it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only, and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.